Hello, Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news about money, and today it's a lot of bad news, but you have to figure out how to find the silver lining or the gold lining of this whole thing. Liquidity crisis.
That's the beginning of a liquidity crisis.
And that's what you're warning everybody about right now.
Right.
I mean, you want a lot of things.
I spoke to someone recently. I said, well, Jim, I hear you. When's all this coming to a head? And I said, maybe this winter or this spring, sooner than you think. And I based that on the last two super liquidity crises when the world almost completely collapsed, or maybe it did, were 1998, that was long-term capital management Russia, and 2008 during Lehman Brothers. But I remind people, okay, September 15th, Sunday, September 15th, 2008, Lehman Brothers filed for bankruptcy electronically on a Sunday night. And that was like, we all know what happened next. But that crisis started in 2007. Remember August 9th, 2007, Jim Cramer and Aaron Burnett on CNBC, and he's yelling, they know nothing. They know. Well, he was right. They didn't know anything. They were idiots. I mean, meaning the Fed. But then, Hank Paulson and the Super Sib and the sovereign wealth fund bailout, and then Bear Stearns, Fannie Mae, Freddie Mac. And so there was a lot leading up to the Lehman Brothers, but it took a year. It took a year to go around. Same thing with long-term capital. It came to a head in September 1998. We were hours away from shutting every financial market in the world. We got the $4 billion in, stabilized the balance sheet, and life went on. But it was a really close call. But that started in June 1997 when Thailand broke the peg to the dollar, started to run on the bank in Thailand. It spread to Malaysia, Indonesia, South Korea. You always hear the expression, time to buy is when there's blood in the streets. Well, sadly, there was blood in the streets, real blood in Korea because people got killed. And then it went to Russia, then long-term capital. But my point is, everyone knows the acute stage, September 98 or September 2008, but it began a year earlier. So now everything we've just been talking about is already happening. It's been happening since last spring. So if you stick to this 1 year rule, and it's not a hard and fast scientific rule, but we've seen two cases where it took a year to come around. If that's your rule, and it started in March 2022, and there's good evidence for that, then kind of March 2023 is your D-Day.
And what was March 2022?
That's when these signs we're talking about, Kim, where the yield on secondary market treasury bills was below what the Fed would give you. Inverted yield curves, big deal. So right now, the Treasury, U.S. Treasury yield curve, you can look this up. I mean, it's not secret data. The yield to maturity on a 1 year bill is lower than a 10-year Treasury note. I'm sorry, it's higher than a 10-year Treasury note. That's called yield curve. Why should that be true? Like if I'm going to lend you money for a year, okay, I might want a certain interest rate. But if I'm going to lend you money for 10 years, I want a higher interest rate because there's more risk, inflation, credit risk, et cetera. So why is the yield on the 10-year note lower than the 1 year bill? It makes no sense, except unless you think something bad is going to happen. If you think we're going to go into a really bad recession in a couple of months, which is what I was just talking about, then that yield on the 10-year note is going to look really good. You're going to have huge capital gains when that actually collapses. The Fed can't control the very short end of the yield curve. They cannot control 5-year notes, 10-year notes, let alone 30-year bonds. So the Treasury yield curve is telling you, it's like right there in your face. It's telling you that something bad is going to happen. Otherwise, those long maturity yields would not be lower unless you think something bad is going to happen.
So again, let's get back to this thing called liquidity crisis. You've been warning, Jim has been warning so many things. They can go in all directions, like Executive 14067 and all that stuff. But I don't want to go down that rabbit hole.
Well, it's you may not.
They're all related.
Yeah, you may not be interested in 14067, but it's interested in you.
Yes. So what does a liquidity crisis look like to mom and pop?
It looks like can't get a loan. Interest rates on credit cards go up. Interest rates on mortgages go up, at least initially. But where it really comes home is that, okay, that's the initial stage. A lot of people don't understand that interest rates peak after the recession begins. It's a lagging indicator because as you go into the recession, people are like, hey, I don't want to lay people off. My revenues are going down. I'll borrow the money. It'll be fine. And then that causes interest rates to go up. But then when it really hits you, just slams you, you're like, okay, I got to fire everybody. And you're lucky you don't go out of business and you default on the loan. So interest rates are a lagging indicator. Unemployment is a lagging indicator because people they really don't want to lay people off. They will if they have to, but that's like the last thing you do after you've cut out a lot of other stuff. So you can't. So people look at unemployment's low and interest rates are high. Everything's good. No, these are the things that these are the things that turn around after the recession.
So one last question. So many people have gotten used to not rehypothecation, but refinancing.
Right.
And so if they cannot refinance their way out,
they default.
That's a crisis on the personal side.
Sure. You default or business defaults, business fail, unemployment goes up and prices come down. And that kind of gets to the second half of my book. So it's 5 chapters. There's an introduction and a conclusion. The first 3 chapters are on the supply chain. Okay. A lot of anecdotal stuff. What's going on? Describe it in detail. Why is it breaking down? And what caused it? That's chapter 2. And then where are we going from here? What's next? What should we expect? That's chapter 3. But there are two more chapters, 4 and 5. One on inflation. But here's the thing nobody sees coming: deflation.
Right.
Because when all this stuff kicks in, the liquidity crisis you're talking about, Robert, and Kim, everything we talked about with the off-balance sheet and the rehypothecation, all that, when all that hits home, you end up in deflation, and nobody's ready for that.
Correct. And so this is I could go on forever. So one of the first things that Biden did was cut off the Keystone XL pipeline.
Right. And
again, I went to U.S. Merchant Marine Academy. I'm an oil tanker driver. When I saw that, I said, he's going to sink the middle class. Mm-hmm. And I'm not really religious, but I remember from Sunday school, they said the poor will always be amongst us. Mm-hmm. But when I saw Biden cut off the Keystone XL pipeline, he screwed the middle class. He just wiped them out.
Right.
And the middle class got wiped out. I got rich. Kim and I got richer because we were selling real oil at $30 a barrel, and oil went to $130 the next day. But mom and pop, this is the microeconomics, mom and pop are standing next to their Lincoln SUV, filling up the gas pump going, how come it was $50 last week, it's $100 this week? So in my opinion, when Biden cut off the Keystone XL pipeline, he basically took out the middle class. How does that fit with your logic?
It fits perfectly, and I agree with that. But then I always ask, well, okay, if the middle class lost, and they did, who's the big winner? The biggest winner of cutting off the Keystone pipeline was Warren Buffett, because a couple of years earlier, he bought the Burlington Northern Railroad.
That's correct.
And what people don't understand, the oil from Alberta is still coming in. It's just instead of coming through a pipeline, which is kind of clean and inexpensive,
which is supply chain, pipelines is supply chain,
but it's coming in by train. Right. So oil tanker cars. So you line up 100 oil tanker cars in one train. It's a pipeline on wheels.
That's why they did that.
Well, that's why Warren Buffett did it. He could see it coming. Gosh. So Warren Buffett owns the railroad. They're bringing in the oil from Alberta. They always have. They're bringing it on Warren Buffett's railroad, not somebody else's Keystone pipeline. So yeah, the middle class gets screwed. That was always part of the plan. And by the way, I mean, these greenies, you have to understand the green news scam people, they've wanted $10 gasoline all along. It had nothing to do with, oil supply and energy supply and demand. They just want $10 gasoline because they don't want anybody to be able to afford to drive, because they want you to buy an electric vehicle. Don't get me started on that. I just invested in a lithium mine in Central Asia because the price of lithium has tripled. I mean, how are you going to make batteries? How do you make a battery? You need lithium, nickel, cobalt,
Silver,
copper, et cetera. You need a lot of poisonous chemicals, basically, that do a lot more environmental damage digging them up. But good luck with that. It's not going to last, but it'll last in the short run because you have idiots in charge. But yeah, they wanted $10 gasoline all along, and they're pretty happy. Jennifer Grantham, our Secretary of Energy, and she's a bird brain, but she's cheering this on because go buy an $80,000 electric vehicle. It's like, wait a second, I can't afford to fill my tank, and you think I can go buy an $80,000 EV, which is made with lithium, by the way, the battery is. And so yeah, we don't need to go there. That's a subject for another day. But the point is, but you're right, Robert. This is by design. Stupidity is not a sufficient explanation because it's actually working very well. You have to say this is what's intended, and they are screwing the middle class.
And then you mentioned WEF and all those other things, and you take grave risks, my friend, grave risks. Anyway, Jim, I could go on forever and ever and ever and ever. And the book is called Sold Out. Please understand it, read that book, because you're going to see the future. And then my first book with Jim was Currency Wars, which I understood because I was part of the Indonesian rupiah crisis out there in Singapore and all that. I was going, what the hell's going on here?
I just have one final question because I know we're out of time. Depression coming, not the other way around.
Yeah, I think depression. I could argue we've been in a depression since 2006, but that's again a subject for another day. But yes, something much worse than a recession. But I also make the point that an economic recession or depression and a financial crisis are two different things. You can have one without the other, and we have, but they can come together. 2008, they came together, and I think they're coming together again in 2023.
That's the liquidity crisis.
Yep.
And a whole bunch of other stuff that we don't talk about in public.